Good morning. My name is Eric Jacobson, Business Growth Specialist with iConnection. iConnection is a website design and web marketing company. Today's webinar is brought to you by Manufacturer Insights. Manufacturer Insights is an alliance between manufacturers and businesses with a desire to share information and knowledge. Our guest speaker today is Brian Krywko, Senior R&D Tax Credit Specialist with Monetek. Brian joined Monetek in 2018 and brings over 20 years of experience as a corporate tax accountant. Let's go ahead and get started.
Hi, today we are going to talk about the Research and Development Tax Credit. Before we do so, I'd like to introduce myself. My name is Brian Krywko, and I am a Senior Research and Development Tax Credit Specialist with Monetek, and I've been with Monetek for 5 years. Prior to joining Monetek, I spent over 20 years in the corporate tax world. Monetek primarily focuses on research and development tax credits, but we have also done some work into other credits such as the ERC or Employer's Retention Credit. Monetek has been in business for over 20 years and is also one of the founding members of the Research and Development Credit Roundtable. The Roundtable is a group of like-minded professionals who meet every other week to discuss court cases and best practices. So now let's move on to what the Research and Development Tax Credit is all about. Let's begin with a little background on the Research and Development Tax Credit. It was created to incentivize research and economic development in the United States. It is a bipartisan tax credit supported by both Republicans and Democrats, as both parties find it beneficial to keep jobs here in this country versus going to other countries. The R&D tax credit is an annual tax credit that can offset either corporate or individual tax liabilities. That all depends on what type of business entity you are. There are also 35 states that have their own R&D tax credit programs. Some states like California and Arizona can be very lucrative tax credits on top of the federal tax credits. The R&D tax credit is based on Code Sections 41 and 174 of the Internal Revenue Code, and it was created in 1981 and became permanent per the 2015 PATH Act. So how can a business utilize the R&D tax credit? Well, first off, it's a dollar-for-dollar tax credit that reduces tax liability owed, and it's not simply a tax deduction. Credit is retroactive and can usually be carried back to all through open tax years. That is usually 3 or 4 years, depending on the jurisdiction. Unused credits carry back 1 year, and that can be carried forward for 20 years. For startup companies, the R&D tax credit can be used against payroll taxes. Professional fees for preparation of the R&D tax credit are also deductible. And in addition, if you plan on selling your business, you can use the credits on the sale of the business. And this is an overlooked thing when companies are sold. So what qualifies for the R&D tax credit? Well, first off, it must pass all 4 parts of what we call the 4-part test. The first test is that it must be for the development of a new or improved business component. Now, business component could be a new product, a new process, computer software, technique, formula, or invention. It does not have to be new to your industry, but it must be new to you in order to meet this test. The second test is that at the start of a project, there must be some technological uncertainty. And this uncertainty could come towards either the capability, as in, can we actually do this? There could be the methodology. All right, how do we do it? Or it could be with the design. How specifically are we going to do it? The third test that must be met is that it must be technological in nature. All that means is that relies on the principles of hard sciences, such as physics, chemistry, biology, engineering, or computer science. So if you have a product and all you're doing is merely changing the color of it, that is not going to be technological in nature, and that would not be, in this example, a qualifying project. The fourth and final test is that there must be a process of experimentation. Now, it could be formal or informal, but usually it's modeling, simulation, systematic trial and error. So one way to sum this up is some of these projects that make you lose sleep at night, or make you pull your hair out, or make your hair turn gray because of all the iterations and versions and trial and error and rework that has to be done. May not be great for business, but they are usually excellent projects for the R&D credit. So what kind of expenses qualify for the R&D tax credit? The R&D tax credit has 3 buckets of expenses. The first bucket is going to be wages. And that is typically your in-house labor for your employees. That's made up of W-2 wages, partner earnings subject to self-employment tax on a partnership or Form 1065 filer, Schedule C income for sole proprietorships. Now there's some exclusions based off COVID-related legislation that also apply as well. The second bucket, supplies and materials used in the performance of research. Now this is not land or depreciable property such as machinery or equipment that are capitalized. Must be used in the research activity. Now some examples of supplies are 3D printing prototypes, raw materials, samples, widgets used in build. Again, it's important. They cannot be capitalized expenditures such as a new machine. The third bucket is contract research. And these are usually third-party expenses you're paying, such as developers who provide code design, designers who provide drawings, lab testing supplies, or labor that's used to assemble prototypes. These vendors are usually paid on a 1099 basis, and you are allowed to take 65% of their qualifying amounts towards the credit. So what kind of documentation will you need in order to take the R&D tax credit? Well, first, you'll have wages that come from individual W-2s and W-3s. Some payroll detail reports or labor detail reports are handy to have show hours worked, and if it's on a project level basis, that's even better. Other documentation for supplies would include general ledgers, itemized invoices or purchase orders, and other documents that can tie supplies to a specific project. For contract research, a general ledger of outside contractors or vendors that fall into the research category will be needed. 1099s are also useful. You would need some originally filed tax returns, especially for the gross receipts section. So all the items on the previous slide will be used to come up with a 3-year base period that needs to be established in order to do the current year's tax credit study. So what that means is if we are doing a 2022 credit study, it must be compared to the prior 3 years, which would be 2019, 2020, and 2021. Other documentation would include project discussions that you would have with engineering experts. And these in-depth discussions would determine whether those projects meet the 4-part test. For those companies who do not have very good timesheet data, or if it's very hard to break employees' times down, especially for those that are salaried, employee activity sheets can be used to allocate employees' time between qualified and non-qualified projects, and also to specific projects. Now, contracts is a very important documentation, and those contracts will often determine whether certain projects are qualified or not qualified. But the main thing is taxpayer must be at economic risk, meaning if you are selling a project to a customer, it must be on a fixed fee basis to be a qualified project. If it's guaranteed maximum price, if it's cost plus time and materials, there's no economic risk to you. Also, if it is funded research, say by a government entity or a foundation or another party, that research, no matter the results of it, is going to be non-qualified. All right, well, let's look at a couple of case studies here to give you some examples of what we are talking about. So first case involves a plastics injection molder. Now this company is headquartered in the Midwest, and they have several locations in other states on the West and East Coast. Their primary business is consumer plastic products. So think like your cups, lids, containers, that kind of stuff. Some of their 2022 R&D projects included, but are not exclusive, were design and testing of plastic container sizing, the implementation of robotic automation production equipment. Now that time used testing to make sure that new machines are working, that they fit into the manufacturing process, that can be qualified, but the actual equipment itself is not qualified expenses. And the last project here, injection mold development and testing. Now for the 2022 year, they had qualified wages towards the credit of 2.158 million, qualified supplies 4.228 million, which brought them a total federal research and development credit of $352,000 and also a state credits of $52,000 for total credits of $404,000. That is going to be cash back into their pockets. It is not a tax deduction. Again, it's a dollar for dollar tax credit. So our second case is going to be for a pet product manufacturer. And this company mainly does development and manufacturing of pet products. These are for dogs and cats also. Well, in 2022, this company actually doubled the number of in-house engineers when compared to 2021. So because their expenses for 2022 were much higher than the prior 3-year average expenses, their tax credit significantly increased, like by well into the 6 figures. Some of their 2022 R&D projects included, but they were not exclusive, were the introduction of a new product line that required extensive design and extensive testing. And this was usually done over a multiple year period. There is also a major internal use software initiative done. Now this company in 2022 had qualified wages for 4.235 million, additional supplies expense of 228,000, and here they did have some third-party qualified contract research payments in the amount of 314,000. Their total federal R&D credit for 2022 was 520,000, and since they had no state credits based on where they did all their research and business, their total credits for the year were at 520,000. So when it comes to choosing a provider or who should do your R&D tax credit, so what things should you be considering in a provider? Well, the first one would be how long has the provider been in business? Obviously, providers who have been around for 50 years will have an advantage over someone that's been in business for 2 years. Second, what does their study process look like? Are they having extensive project discussions, or are they just taking your word that these projects are qualified? How are they determining whether these projects qualify? Are they determining qualified expenditures by project level? And what type of substantiation will you receive? In the unfortunate event of an IRS audit, that substantiation is going to be very important to help you survive your audit. So let's touch on some of the updated guidance issued from the IRS. A lot of it is based off what we call the Little Sandy Coal case. And you can see that this appeal was won by the IRS in March of this year. Little Sandy Coal was a shipbuilding division that was designing and constructing vessels. Their qualified expenses versus their non-qualified expenses were what the IRS had their issues with, mainly claiming wages that were not associated with any specific projects. So as such now, where in prior years the IRS audit guidelines dealt with more an activity level, now they are down into the business component level. What the IRS looks for is a breakdown of the qualified research expenditures on a project or / business component basis. And it's extremely important, especially in today's audit environment, to ensure that the credit is not only accurately calculated, but that it remains audit compliant. So one other thing that we should bring up is what we're calling the 2022 amortization rule. This was brought on by the Tax Cuts and Jobs Act all the way back in 2017, and that stated that starting 1/1/2022, taxpayers must capitalize and amortize Section 174 expenditures ratably over a 5-year period. Now, really quick, what is a Section 174 expense? So R&D expenses are generally considered to be both Section 41 and 174 expenses. Now, there is some differences. Patent-related expenses, for example, are not eligible for the R&D tax credit, but they are considered a Section 174 expense. Also, the R&D tax credit wage bucket is based off of Box 1 federal income tax wages, while Section 174 uses Box 5 Medicare wages. Now, prior to 1/1/2022, taxpayers were allowed to deduct these costs directly on their tax returns. But starting 1/1/2022, they must capitalize them and deduct them over a 5-year period. So for the first couple of years, as you can imagine, this results in a tax timing difference related to 174 deduction. This is going to cause increased estimated tax payments and higher tax liabilities. Now, currently it's in effect. We are hoping that legislation is done by the end of the year to repeal this, but there is no guarantee. This is going to be something that has to be considered in tax planning and makes it even more important to take an R&D tax credit so that way you can offset it. The 174 costs should be added back whether or not you are taking an R&D tax credit. And finally, here's my contact information. Feel free to email or call me at any time if you have any questions or if you want to talk about the credits more. Well, thank you for spending a few minutes of your time listening. Have a great day.